If you are following the crypto space, you have probably heard about platforms offering you interest or yield on your various cryptocurrencies, tokens, or stablecoin. But what are these crypto lending products? How do they work? And what are the risks that you need to know? We'll cover them all in this episode of your FinTech Capsule Explainer series. This episode of my FinTech Capsule Explainer series is brought to you by Crypto.com, where you can buy Bitcoin and over 100 other cryptocurrencies with over 20 different fiat currencies. New users can enjoy 0% credit debit card fees on all crypto purchases made in the first 30 days. Check out the link above to download the Crypto.com app and for more details. As crypto adoption continues to accelerate around the globe and numerous retail and institutional investors are entering the space, we're beginning to see numerous crypto platforms offer users to earn interest on their crypto assets. There are essentially two types of platforms offering such products. First are those offered by centralized entities, the likes of BlockFi, Celsius, Nexo, Crypto.com, Ledin, YieldApp, and the list goes on and on. Second are the products offered by decentralized platforms, the likes of Aave, Compound, and others that basically do the same thing but in a decentralized ecosystem. These offerings have been very popular in recent months as they're able to offer very interesting yields in exchange of you depositing your crypto with them. On certain assets, the interest rate is sometimes double digit, even for US dollar stablecoins. This obviously makes such products very interesting for investors, especially in the near zero interest rate environment we currently live in. But how do these platforms work? Let's first start with the centralized platforms because they are the ones that the majority of users would probably experience first. The actual mechanism of what happens behind the scenes is quite simple and very similar to what your traditional bank does with your interest-bearing savings accounts that you have with them. A user that has crypto, like Bitcoin, Ethereum, or stablecoins like USDC, can simply transfer or lend that crypto to that platform that they're using in exchange for some interest. Every day, week, or month, you'll receive some interest, generally the same currency as the asset you deposited. So if you have a buy and hold strategy with your crypto assets, this allows you to generate some interest on those assets. But how is this platform able to pay you that interest? Well, not too dissimilar to a bank, these platforms go and lend it out to others who want to borrow it. There are numerous retail or institutional traders that are looking to borrow crypto either to short or leverage their position, often for short-term trades. If the crypto platform is giving you as a depositor, say 5%, that means that they're lending it out at, say, 8% to those retail institutional traders, and the platform is pocketing the difference of 2%. Many crypto users prefer to use centralized platforms as they tend to be more user-friendly, offer customer support, and don't require the same level of technical skills demanded by DeFi platforms. But that doesn't mean that using centralized platform doesn't come without risk. The most obvious risk for users, regardless of whether they're an institutional investor or retail depositor, is counterparty risk. For example, while these crypto lending platforms will always over-collateralize their loans, meaning a trader can only borrow $5,000 for $10,000 worth of crypto provided as collateral, the risk always remains that crypto markets could suddenly plummet, leaving traders without the ability to meet margin calls or the platform to liquidate the collateral in time. This means that any crypto you have deposited with them could possibly be lost. Although such platforms were able to easily sustain some of the large downwards market swings in crypto in recent months and years, the risk always remains. And unlike when you deposit your money in a bank, for instance, there is no FDIC-like insurance for such products in the event the platform goes bust. Another potential risk for these lending platforms is traditional fraud risk. For example, a platform may not be able to give you back your funds due to fraudulent activity or negligent risk management on their side. The case of lending platform Cred, which left hundreds of depositors in limbo after the firm filed for bankruptcy in 2020, is a good example. Subsequent investigations found out the firm had no internal compliance or due diligence processes and procedures. Its chief capital officer was a fugitive on the run, and that he had illegally transferred the user funds to a separate entity. And another risk that is always present is that of hacking. In a centralized lending platform, you transfer your crypto to the platform, so there is always a risk that the platform or its underlying custodian gets hacked. Many of these platforms have some level of insurance, but the reality is that the amounts of insurance are minimal compared to the assets they hold. This is why it's important to do proper due diligence before depositing your funds on any of these platforms. You may also want to use different platforms in order to minimize counterparty risk. You also need to make a decision on whether the interest rate that you're being given is worth the counterparty risk that you're facing. It's likely that such platforms will be all regulated over the coming years, which should, in theory, give more investor protection, But until then, please do your due diligence. Now that we've covered centralized lending platforms, it's important to remember that there are numerous ones as well in the DeFi space. In these DeFi platforms, the mechanism of borrowing and lending is similar, with the only difference being that there is no centralized intermediary. Although DeFi has many benefits, from being permissionless to eliminating counterparty risk, the decentralized finance space is hardly risk-free either. Take smart contract risk, for example. While centralized platforms have human-related risk, the risk in DeFi platform is that there is a bug in the code of the smart contract, or there's a vulnerability that has not been patched yet. In such cases, you may lose all your assets. And unlike your centralized platforms, there's no customer support team to contact. And there's also the risk of hacking in DeFi as well. But unlike a hack of a custodian or platform in the case of a centralized platform, the risk here is that you get hacked on your own wallet where you're holding your private keys. Which one is more secure is an eternal debate in the crypto community and depends on your personal circumstances and experience in crypto. But despite some of these risks, the reality is that people are generally happy to lend out their crypto as they're able to earn a yield on it. Although yields for crypto lending have gradually begun to come down, they still remain quite appealing, especially when compared to yields offered by traditional financial institutions. As many crypto investors are holding Bitcoin and other crypto assets for the long run, such yield enhancement products allow these investors to generate some returns on these assets while they continue to hodl them. Hope this was a useful video. If there's any other topic you'd like me to cover in the future explainer video, please feel free to let me know in the comments below. See you all soon for another episode of your FinTech Capsule Explainer Series.